The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Joining us now to discuss the crypto markets is Greg Magadini, CEO of crypto options analytics firm Genesis Volatility. Hi, Greg. Let's jump right into the markets chat. So earlier on, I said that, this was kind of a price looking for a narrative, and we don't really have a coherent narrative about why Bitcoin has been going up recently. Feel free to correct me if I'm wrong. Is there some super narrative that I'm missing here about what's bringing crypto prices up over the past few days?
Thanks, Emily. I really appreciate that. Actually, I love that quote. I'm going to steal that from now on. That's a really good quote. So the way that I think about it is that I'm looking at 2018 as a really good template for 2022. And I think that essentially we have this macro environment where the Fed has to fight inflation and are afforded the opportunity to raise rates until markets break by the very low unemployment rate. So I think what we're seeing here is just kind of a normal risk on asset sort of reaction. And what we're seeing right now is similar to what we saw in 2018, is that markets have sort of these wiggles, and right now we're on an up wiggle, and we're probably going to see some consolidation, probably between 20 to 27,000 in Bitcoin. And then I still think there's probably some downside in sort of the medium term to crypto. Now, I think this also affords a really nice opportunity in the sense that unless the sort of inflation situation is fixed, once the job market starts to see an uptick in unemployment, at some point the Federal Reserve becomes stuck between a rock and a hard place, and they have to decide, okay, the economy's going in these recessionary trends. Should I keep fighting inflation, or should I now kind of balance my mandates between inflation and full employment? And so we might get the situation where the Fed decides, okay, I'm gonna start focusing on unemployment now. Inflation situation might not be fixed long term, and now assets are cheap and they become the inflation hedge that people are looking for. And so then maybe the next 5 to 10 years, it becomes a really nice buying opportunity. So that's kind of how I'm thinking about it, and I just really think that 2018 is a good look.
Well, you have some great charts you sent to us on this very thing, some interesting wiggles. Let's take a look at this P&L chart. A really interesting comparison between the annual trends of 2018 and the bear market then, and in blue we see there, to the 2022 bear market in light blue. And you're seeing a pattern here.
Yep, exactly. And kind of like in the middle of the year, just like in 2018, we really had this up move. And so that's kind of what we're seeing right now. Again, I think these are just market wiggles with no necessary fundamental catalyst. And then after that, we saw kind of a consolidation. And at the very tail end of 2018, we saw another leg lower.
Well, we also have the skew constant maturity chart. Tell us what patterns you're seeing in there once they pull it up. There it is.
Yeah, absolutely. So something interesting that we're seeing right now on this rally is that there's a lot of enthusiasm around ETH 2.0, proof of stake, so on and so forth. And so if we look at the options market, one of the things that we're seeing is that for the first time in quite a few months, we're getting the options asymmetry to the call side. So that zero line is basically telling us if calls and puts were equally priced, the skew would be at zero. Right now, we're in the positive territory, so the risk reversal is telling us that people are paying more for calls than equidistant puts. And the way that I would think about this is that one of the interesting components that we're seeing in the market right now is that all the fixed maturities of the options market are now in positive territory. So if I'm looking at something like 180 days or 90 days out in terms of the options market, all of a sudden on this past week of activity, we're pricing the next 90 or next 180 days with the same sort of volatility asymmetry to the upside. I think that if I wanted to take the other side of this trade, the way that I would do it is I would go into these longer term options and sell that skew back the other way, betting that's probably going to go back into this negative territory.
Okay. And finally, you have a spot implied volatility chart. And in the end there, we see it in a bit of a range. Tell us what we're seeing here.
Yeah, so this is the Deribit D-Vol index. You can think of it as the Bitcoin VIX. And some of the interesting points I want to show here is that we have these two big spikes, and they correspond to the Luna UST meltdown, as well as sort of the three-arrow contagion effect. And so given those narratives and those catalysts, we can see how high volatility goes. And in between UST and three arrows, we kind of have this drop back down in implied vol, or the D-Vol index. And so I think that's kind of a logical target to think about where volatility should reside going forward, assuming these contagion effects are behind us. And one of the things to keep in mind is that in this environment where we have deleveraging, essentially, like after the fact of this deleveraging, things are on a lot stronger footing. So a lot of the strategies that brought down these big firms are the staked ETH versus regular ETH trade, which is basically beacon chain ETH, which has a yield to it, but it's locked up until the launch, and you can hedge that with Ethereum. So essentially, that's a very smart trade. Just like long-term capital management traded on the run and off the run treasuries, those things should converge in the future. It's a guarantee. The problem is that in between now and then, there's a lot of positioning. So people get crowded in the same trade. And the second someone starts needing to get out, they kind of widen that spread as they get liquidated. And then the next set of people gets liquidated and that spread widens even more, so on and so forth. And then you get sort of that contagion effect where everyone gets liquidated and it's kind of a self-cannibalizing effect. Well, once that's out of the market, people are on a lot stronger footing, and this potential for kind of crazy crashes and liquidations of big players diminishes a lot. It's sort of like the forest fire clears the brush. And right now we're in the brush clearing phase. I'm kind of the opinion that a lot of these losses have now been measured and accounted for, and people are aware of them. So a lot of the brush burning is probably behind us. But now going forward, we're going to have a lot more safe and strong environment.
So just that's pretty optimistic about the brush burning. But I guess the question is how much lower do you think we could go? I mean, in the sort of more negative scenario where there's more brushes to be burned.
Yes. So I think the spot prices can absolutely go lower. Let's remember, Ethereum, for example, this asset 6 years ago was in the $6 to $10 range. So I think theoretically, like, we can get back into the $600 range, $500 range going forward. But I think the sort of the panic of firms going under because of sort of asymmetric risk, I think that's probably behind us. I think as far as like big firms going under, we're sort of done with that. The prices of Ethereum, Bitcoin, crypto in general as a risk asset, there's probably more downside just because of that macro situation where the Fed has to fight inflation. They're going to keep doing that until markets break, until the economy breaks. So as long as we're at full employment, I think the Fed has no problem raising rates until we're not at full employment.